Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which was one of the top performing indexes over the past decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Tuesday afternoon, we have Shawn, Cruz, manager of trader services over at TD Ameritrade. We'll get a fresh look at Nasdaq-100 levels, VOLQ. We'll also preview LYFT earnings. Shawn, it's great to see you as always. Welcome back to Trade Talks. And let's take a look at your first chart here, get some fresh levels in the Nasdaq-100, as all the major averages, in fact, are trading near all-time highs.
They are, and actually one thing that I thought was interesting, I always like to just sort of look, especially when we're seeing just the gains that the Nasdaq-100 has been able to make almost week after week after week. It's trying to just look for levels that could become support, because I do think that's important, is that at some point you may need to establish a little bit of a base that then you can consolidate at and then start maybe making another leg higher. But right now it actually looks like there's a little bit of a wedge building here, and I'm looking at that price level that's right at around 14,863 is the support level I'm looking at. It looks like we just want to see a sustained breakout. I think if you do get that, then you can start to go back up and look at that. Those areas around like 15,125 for another new high, but certainly watching that level right around 14,863 as a potential support that we will want to see hold. Otherwise, you sort of have these baby step $100 incremental levels below that you're going to want to keep an eye out for if we do start to break down. But we're not really seeing any indications that is anything that we should be expecting anytime soon, just looking at how the market is behaving at the moment.
Yeah, even when we take a look at the Nasdaq Volatility Index, or VOLQ, is actually quite muted for earnings season, surprisingly so. So anything that you're looking at there, I feel like the concern always is with the indexes awaiting and the the top 8 to 10 that have so much influence on it. So is there anything that you're seeing in VOLQ that could suggest some choppiness as we get through the end of the summer?
I mean, I think it is telling you to expect general choppiness. So we're looking at these, we like to go off that rule of 16. And if you divide whatever that number is, that volatility index is trading at, divide it by 16, and that sort of gives you the expected range for the next 2 or 3 days for the index to trade inside of. And right now it's telling you don't expect anything more than up or down 1% over the next 2 or 3 days. And that's not to say it's going to go up 1% or down 1%, but that's just sort of the range you should expect it to sort of chop back and forth in over at least the short term. I think it's very interesting that right now VOLQ is actually a decent amount below the VIX or the SP 500 index. And I think the big reason you're seeing that is, if you think about it, we're starting to get through the bulk of earnings season here, but we've certainly heard from most of the mega cap tech companies. And so when you do start to have a lot of those companies getting their earnings in the rear view, that's sort of going to just sap out some of that overall aggregate implied volatility for the index that they compose such a large portion of. So I do think it is something, when I say I don't really see anything in the offing here that indicates we should be prepared for a sizable pullback. The reason I say that is we have already gotten through a lot of the mega cap and a lot of the other Nasdaq-100 component earnings. There's still some to go, but so far I think we have a pretty good feel for what we can expect for the rest of earnings season. And I think now the market, once we do get through this, we'll probably start looking ahead to what's going on with things around the Federal Reserve, what that means for interest rates, things on the Delta front for the COVID variant. I think they will start to refocus on that. That might drive some more choppiness, but at least for the time being, doesn't look like there is a serious concern of the market for a massive move, particularly a massive pullback to the downside.
Well, the market's always worried about something, isn't it, Shawn? If it's not one thing, it's certainly something else. Let's preview LYFT earnings. It's hard to believe it's been about 2.25 years since it debuted in March 2019 on Nasdaq, and it's kind of been through a tumultuous ride, if you will, pardon the pun, just like the rest of the market.
Yeah, and I think it's going to be interesting to kind of get a feel for how some of the companies in this space fare. LYFT has actually done pretty well this year into this recovery. And I think the reason why is, if you look at LYFT's business, they're focused geographically in the US, and they're really focused more in that ride share. They're not so much in the food delivery market. They do have a partnership with Grubhub that they do offer delivery services for, but by and large, the bulk of their business is in just actually moving moving people from point A to point B. And as we've gotten into the reopenings, we've had restrictions eased. If you look at a lot of the sort of anecdotal data, you can get TSA checks and what you're seeing there. We're seeing recovery there. You go at Red Book sales, people are getting back into stores. Sort of shows that mobility of people out and about is picking back up. And for Lyft, who is almost purely focused in that strictly ride sharing market, that's a good sign. So I do think the one thing is going to be keeping an eye out for any sort of updates on any regulatory risks coming out for the business. It's a big part of their model, but also looking at the trade-off between price and volume, because they're now having a little bit of an issue with not having as many drivers out there on the road. And what they're doing to offset that is they're actually increasing prices. So the question will become, are they going to be able to right size that so the price increases aren't clipping volume too much? Is there going to be a little bit of a trade-off there? I would expect that to be the case. I think the key metric you're going to look at in this report is going to be the average revenue per an active rider, and they're expecting that to come in right at around $45. I think that is going to be key for this report in terms of what we look at. And then we're going to want to get a little bit of a guide for what their revenue expectations are in the second half of the year. So two big things to look at. Look at that average revenue per an active rider, and then look at the revenue guidance for the second half of the year.
All right, Shawn, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.